I stepped up things a year or two ago and brought in a colleague so he's an experienced investment professional. And I met him at the second company that I invested in. He was on the board. It was Soros Fund project. So I got to know him. And then a couple of years ago, I realized I would occasionally ask him for help. And I would say, let's meet you for a glass of wine. And I'd ask him some questions. I realized I could use more than that much help. So he and I are working together now. And it's Ben Matranga. So Ben has introduced this idea that I think is a good idea of, instead of only thinking of investment as, oh, we're going to buy shares, we're going to have a share of the company. Well, there's a place for that, but he said another thing you can do is offer loans. Little companies have trouble getting loans at good rates. Big companies thrive on debt. Even AT&T, you think, oh, it's a successful company, they don't need to borrow money. No, they have outstanding about $140 billion in loans. And they just run their business and they know, okay, we can borrow money, we can grow the company. That's not available to small companies. The interest rates are high. They need 100% coverage of assets to borrow money. So if you want to borrow $1,000, the bank says, fine, put $1,000 in my bank, I'll lend you $1,000. What good is that? Or we want the title to your house in the bank vault, and we want serial numbers of all your assets that you're claiming. We'll hold on to them. You can't sell them. So it's difficult. And Ben explained all these things to me because of his previous investment experience. So we set out to make a sector-specific debt fund. So we're going to only loan for internet stuff, ISPs in particular, we think are an opportunity. We are going to target companies that have been in business for at least 2 years, 3 to 5 probably. We will want to see 2 years of audited returns. It has to be a registered company. It has to be cash flow positive or close to it. And so these are companies that have figured out, that know what they're doing, have some track record of doing it, and want to expand. And so then we can help them expand by providing capital. They have to pay it back, but then if they know what they're doing, they'll take this money, build the network, grow their business, pay it back, borrow some more maybe even. And so compared to equity investing, it has a couple advantages. The principal of them is it's self-liquidating. So everyone knows about VCs in Silicon Valley and thinks, oh, that's fantastic. Well, it is fantastic, but I think it's a bit unusual, and I don't think it should be necessarily the case that, oh, let's copy Silicon Valley. Most businesses in the world should not do that, and particularly these network businesses, network infrastructure. I distinguish between infrastructure, which is extending the internet, from internet services. And frankly, I only know about how to move packets and about network level of internet. I don't know about web services and systems. I don't know about DNS hardly, but there's lots of need for packets, so we do that. But infrastructure requires building a bit of capital to deploy. It's a simple business. We buy wholesale internet, extend it out over relays and infrastructure that we build, and then we sell retail. So that's never going to have a hockey stick growth. It's never going to just take off all by itself, because you have to build the infrastructure. So it's a slower growth, but it's steady, because once you build a network, if you do a good job, people don't leave. You lose some people, but you get some more. So it's steady. So the analogy is that it's like you're going to build apartment buildings and then rent them out. So once you got it built, then you can expect regular income. And so in that scenario, debt is a good thing, or it's a typical way to do it. But by analogy, it's very common for people to borrow money to buy a house, but it's a little more difficult if you're a builder and you don't have money, but you know people, you know a good place. You say to the banker, see that land over there? I want to buy that land, and I want to buy equipment and hire people, and then I'm going to have a nice apartment building, and I'm going to rent it out. They say, but there's no, how can I lend you money? There's nothing. So that's kind of what we're doing, because we think we know the sector, so we can look at their track record and lend against their experience, their assets they would have, their cash flow, and so it's a sector-specific debt facility. Another way of describing it is it's small business banking 101 for networks.